All right, folks, fall break is upon us, and I stand upon the precipice right in your way. I guess Michael and Parker, you guys don't really get fall break, do you? So, yeah, so you got to be here for the football game. Do you still have to practice on Thursday and Friday as well? Oh, that's a bummer. I guess that's the drawback of being a student athlete is that you're required to be on. I mean, that's kind of I kind of can I can't relate to being a student athlete. I was never in that situation, but I can relate to requirements because all my friends say, yeah, we're making a trip down to wherever on during the fall, and I was like, well, I hope you have a good trip. I can't join you because I'm going to be here in class teaching, completing the audit engagement or whatever it is. Schedule is not flexible. It is not flexible. All right, before we get started, I wanted to talk about the rest of the schedule for the semester. Some things I want to make sure everybody's updated on. I probably should have done this much sooner, but we've been having so much fun in class that I haven't wanted to stop a moment to take away. But time is here. So when we get back, we're going to be doing basically our final chapter reviews. So that'll be week 9. Week 10 is our exam number 2. It's only 2 weeks away. 2 weeks away from today. Time flies when you're having fun, right? Yeah. After exam number 2, we have a few assignments that you want to be aware of. First of all, we've got the Excel assignment. I warned you a little bit about the Excel assignment. It does sneak up very quickly. It will sneak up quickly. My best advice is to start looking at the Excel assignment now. I'm not saying you need to complete it now, but if you wait till the day before the assignment is due, you're going to be in a really, really big world of hurt. If you wait the day of the assignment, you won't complete it. That's all there is to it. I have empirical evidence on that one, by the way. So please make sure you start looking at the Excel assignment, get that done. It is not difficult. It is time consuming. So that's something you need to keep in mind. That is due 7th of October, which I know that's a month away. It doesn't seem like forever. Like, I remember when I was young and month seemed like a long period of time. Now it just seems like 4 weeks. What am I going to do? So yeah, a month away. Also, your professional interaction is due the week after that. You should remember professional interactions from AIS. That's basically where you have to visit a presentation and you have to do a little bit of write-up on it. It's not particularly onerous. It's just to help you develop your professional networks. I think a few of you have already submitted yours or had opportunities to go to professional interactions, so you can do the write-ups on those. But it's in the syllabus, the details. It's not particularly difficult. The one thing I wanted to remind you, so we got our exam 3 right before Thanksgiving, and because I'm a monster, I will not give you the results discussion until after Thanksgiving, So actually the reason for that is benevolent. It just seems like I'm a monster. The reason why is that I always give my students the Friday off before Thanksgiving because they want to have that little time. It's really hard to focus when you're really on the precipice of a 1 week break. So it was either give you off and then review the exam results after Thanksgiving, or we have to come in on Friday. Now, we could take a vote if you want to, and if everybody wants to come in on Friday, then we could do that. Everybody's like, nope, not going to do that. Yeah. I will share some preliminary results with you, but we won't have the detailed exam discussion until after you get back from break. So I won't make you wait a week and a half for your grades. I will disclose those, but I won't be able to tell you why you got your grades until after you get back. Then we have group presentations. We have 1 group already formed. We have 2 more groups waiting to be formed, which we need to do that soon. My usual cutoff for this is week 8. We're in week 8, which I haven't mentioned it. So if you've not already formed a group yet, just keep in mind that if there are people that you want to be in a group with, that reach out to me and say, I'd like to be in a group with these individuals, and I will do my best to put you in that. If you have no preference, I'll assign you to a group at random. But start thinking about that and who the group is that you want to be formed with and the individuals you want to be in a group with. And then we'll get those groups formed. There will be 3 groups, 5 members each, and the topics are listed on front. So there's a lot to think about. There's the people you want to be in a group with, what it is you want to present on, and the day you want to present. The way the presentations will work is we'll have 2 presentations on the 3rd, and we'll have a single presentation on the 5th to get that up with. So you have a preference there. I would like to request, and this might be relevant to some individuals in the room, not going to mention any names, but if you have an event that you cannot attend or attend a particular class session for, please make sure you get your presentation scheduled for not that date. Has that happened in the past? It happened back in spring several years ago. I had 3 softball players in a group, and guess what? They had softball playoffs on the day that they had scheduled the presentation. Made it for a very, very awkward time about how we were going to do that because finals week was the week after. So we actually had to have a presentation during finals week. So please keep that in mind in scheduling. And if you can't do it on either day, I'm not sure what to tell you, but I'm assuming that's not going to be a problem, especially in December. All right, with that, we've got to talk about completing the audit engagement. So this is a really awkward series to talk about. We've jumped way ahead in chapters. So last time we were on chapter 9, and now we're on chapter 17. We've completely skipped chapters 10 through 16. And we're going to come back and review those. But part of the reason that we're skipping those is that I want to talk about the conceptual approach before I talk about the specific approach. Chapters 10 through 16 will move like lightning. We will go through those very quickly. There is a lot to cover. I will tell you chapters 10 and 11 are going to be very, very dense, and they're going to be within a week of time. Chapter 12 is actually pretty short. We'll have a short class on that, and then chapter 13 will be pretty dense. And then we'll have another short class session, and then we'll do chapter 14, 15, and 16 all in the same week. So density followed by a bit of a break, followed by more density. But those are going to be specific applications of everything that we're going to be learning. But let's assume that we have all completed the audit. We know the general concepts to complete an audit. We know the approach. We know we start the audit, we accept the engagement, or we continue in the engagement, whatever it may be. We assess risk in the engagement. Then we actually start working on the testing. Or actually, I should say, we accept the engagement, we start planning. Once we finished our plan, we assess risk. Then we are going to do our test of controls. Then we're going to do our substantive analytical procedures. And then finally, our substantive test of details. So we know all of those. We've talked about those at a conceptual level. We'll talk about those specifically a little bit later. We are at the end of the audit. So what is it that we have to do to wrap up an audit? Is it just once we finish substantive test of details, we're done? If only it were that simple. If only it were that simple. There are some very specific considerations we have to take into account when we complete an audit. So some of this should be fairly familiar, but these are all auditor responsibilities that we have to make sure that we cover before we conclude an audit. Now, this is going to run really closely into what we're going to cover next Monday. Next Monday, we're going to talk about issuing the audit report, which is legitimately the final step of the audit. Once we've wrapped everything up, we issue the report and say, all right, here's the report, we're done. All right. It's just like if you've ever been in a casino, like, yeah, like that, yeah, showing everything's done. Okay. So that's basically where we're at right now. So let's talk about what we need to do to wrap up before we issue the report. So first thing, we're going to harken back to 303. I'm going to say that a lot in this lecture, by the way. You're going to hear me say, let's go back to 303. How many people had Dr. Deers for 303? Okay, pretty much everyone. Some people had Dr. Shaniwa. Okay. Oh, I said he who shall not be named. My apologies. Sorry, yeah. Mentioned his name. I think there's actually some slides with him in there. I couldn't get rid of it just because it was too hilarious. I'm gonna have to get rid of it eventually. But so in 303, you remember talking about contingent liabilities. It was one of the very first things you talked about in 303 in intermediate 2. And so the idea of contingent liability is that this is an existing condition or a set of circumstances involving uncertainty about a possible loss that will ultimately be resolved when some future event occurs or fail to occur. So prime example of a contingent liability is litigation that is ongoing. You've got a lawsuit that has not yet been resolved or settled. And so there's some concern about what is that going to be. Now, the rules for contingent liabilities are pretty transparent and straightforward. It has to be at least probable and reasonably estimable. If it is, we have to accrue the contingent liability. Now, if we think that it's less than probable or reasonably estimable, usually it's going to involve disclosure only. Or if it's if it's known or probable, then or known or reasonably estimable, then we can accrue liability. If we think it's probable, but we can't estimate it, then we're going to disclosure. Or if it's only reasonably possible but not probable, it's disclosure. If it's remote, we don't have to do anything. That's basically kind of the criteria saying we don't think that this is ever going to amount to anything. There's no reason to actually mention this liability or to accrue for the liability. So these are the rules from financial accounting, and these are the rules that we have to adhere to. So just important to keep that in mind. I know this is technically a financial accounting question. You said, you're going to say, Dr. Barnes, you promised no financial accounting. I said, I promised minimal financial accounting. This is one of those things. Since we're auditing according to GAAP, we have to know what the GAAP rules are. This GAAP rule states that contingent liabilities, what are the rules for disclosure and what are the rules for accrual? By the way, is everybody familiar when I say disclosure versus accrual, what the difference between that is? If it's a disclosure, it gets mentioned in the financial statement. If it's accrual, it goes directly into the financials. It goes directly into the financial statements. And so if you record a journal entry, you record whatever the effect of that journal entry would be as if it happened. So that's going to be the example of an accrual. Now, this is the financial accounting stuff. And again, this is really important, but I wouldn't mention this if there weren't some audit impact. So what are some audit procedures for auditors to help identify contingent liabilities? Now, think about this from the audit perspective. If you're auditing your client, what is the likelihood that they're going to want to disclose every single contingent liability or accrue for all contingent liabilities? They probably are having an incentive not to. So they think about it just logically. You're a company and you've got a lawsuit against you, and you know this lawsuit is going to be devastating. You're going to have to pay out millions of dollars. You are almost certain that's going to be the case, and you can predict the value of it. GAAP rules tell you that you're supposed to accrue for that. You're supposed to book a journal entry to show the effect of on the financial statements. Are you incentivized to avoid doing that? Yes, okay. That's where we as the auditors step in and say, hey, look, you've got a contingent liability here. You've got to record this. You've got to book an accrual for this. You've got to book a journal entry to record this particular liability. Or in lesser situations, you've got to disclose the impact of the contingent liability. So what are the things that we're going to do as auditors to be able to understand what the contingent liabilities are and identify where they occur? Well, the easy way is going to be able to review the accounting records. So inspection of records and documents. We're going to look at the meeting minutes of corporate governance and shareholders group, look at sales and purchase contracts, loan agreements and leases, tax returns, and guarantee arrangements. All right. All of these are examples of accounting records that might expose if a contingent liability in a certain area exists. In addition to that, we can send out confirmation requests to different parties, such as financial institutions or lending agencies that might shed light on possible contingent liabilities that occur. All right. So that's going to be some procedures that we can run to identify contingent liabilities. But there's some other options that will help us in this regard. Near the end of the audit, we should do some other procedures. That's first of all, we're going to inquire with management regarding the process for identifying and evaluating contingent liabilities. Now, this is just talking with management saying, what is your procedure for making sure that all contingent liabilities have been identified and then appropriate accounting treatment for this? But as we know, inquiry by itself is not sufficient. Okay, inquiry by itself is not going to work. So we have to do some other steps as well. We're going to examine correspondence with attorneys for pending or threatened lawsuits. So any conversations that they've had with attorneys about lawsuits that have existed, we're going to look at that as auditors to try to get some understanding about whether a contingent liability exists. We're going to obtain something called a legal letter that describes and evaluates all pending litigations, claims, and assessments. Okay, well, we're going to talk about the legal letter in just a second, what that means. We also want to obtain written representation from management that all litigation claims and assessments have been disclosed. This last step is basically a CYA, okay? And this is one of those things where we try to make sure that we have disclosed, we did everything possible to make sure that contingent liabilities have been identified and been treated properly. Now, if you're an auditor and you fail to identify a contingent liability, does this representation right here, this written representation, protect you? Not really, okay? If it was something that you should have captured during the course of the audit, you're still going to be held accountable for it. But the written representation does give you some deniability, does give you some coverage, just not full coverage, especially if it's something that you should have identified through the course of the audit. But let's go ahead and talk about the legal letter. And if we're going to talk about legal letters, you know who I have to deal with? We have to deal with the friggin' lawyers, okay? We have to deal with this guy, and especially this guy right here, okay? I honestly was really, really tempted to kind of take this image because he looks so diligent. He looks so kind and polite in that picture. I wanted to take this picture and kind of Photoshop and put like an evil villain's mustache on him, because I think that's more appropriate for this role. Okay, because let's be honest, he seems so nice and kind. He seems but he's a lawyer. Okay, he's a lawyer. All right, it's just one of those things now. So we have to deal with the attorneys. All right. We're going to have to deal with the attorneys. We're going to correspond with them. And we would like to think that every single attorney that we deal with is going to be as nice and polite as this guy and kind to this guy. All right. If you've never interacted with Dr. Smith, he'll tell you to your face if he thinks that you're full of it. But Professor Smith. But these guys, very, very polite and very, very kind until they go into full lawyer mode. And then watch out. All right. Then watch out. So we're going to send them something called a letter of audit inquiry, which we're going to shorten as legal letter. And basically, this is something we send to the attorneys as primary means of obtaining or corroborating information about litigations, claims, and assessments. Now, this is the book definition, by the way. I do want to edit this definition. So this is one of those ones where we're going to edit outside of what's in the slides. So if you're just kind of passively looking at the slides and saying, I've got all the information I need. No, you don't. All right. Because I want to talk about this statement that it's a primary means of obtaining information. My note in here in my slides say this is not an effective method for obtaining information about contingent liabilities or commitments. Okay, we'll talk about commitments here in just a second, what that entails. But why did I include it up here if I personally disagree? Why did I say obtaining and then say, no, it's not? Think about this logically. Who does the attorney of your client represent? Do they represent you or do they represent their client? The client, okay? So whose best interest are they going to serve? So if I go to the attorney and say, hey, here are all the contingent liabilities that I've identified. Are there any more that you're aware of that you can share with me? What is that attorney going to tell you? Nope, you got everything. My lips are sealed because it's a lawyer, okay? And a lawyer works for the highest bidder because of course they do, all right? Yeah, it was Professor Templeton's teaching on the way I'd yell at him, okay? But I think he's in his office right now, so he can't hear me. If you ever watch this, Scotty T, got my eyes on you, all right? So anyway, yeah, we cannot obtain information directly from the lawyers. They're not going to provide that to us. So this is mostly a means of corroboration. All right. And that's the idea, is that if we have information that the client has shared with us, we can use the lawyer to corroborate that information, to say they can tell us any additional details they would be willing to provide about information we already know. But they will not volunteer information that we don't have. It's just very, very unlikely that's going to happen. So make sure you've got that edit up here. If you want to scratch out obtaining and say Dr. Barnes lied to me, that's fair. Okay. Okay. The slides are full of it. The slides are full of it. But we had this conversation and that was fun. We got to poke fun at Scotty T, and that's all that really matters. Okay. If I get to do that once a lecture, I'm a happy person. All right, so let's talk about commitments. I mentioned commitments, and commitments are basically long-term obligations to purchase materials or sell products at a fixed price. You've probably heard of hedging and derivatives, and this is kind of accounting that goes into, which are basically things that nobody other than Dr. Eisen understands. Okay, you may say, Dr. Barnes, you understand it, right? I said, yeah, sure. Okay, so what do we mean when we talk about commitments? So it's going to, the goal of it is to obtain favorable, predictable pricing or secure the availability of materials. Interestingly, with our internal audit visitors last Monday, we were talking about the nature of commitments and how that happened with Southwest back in the mid 2000s, is that they actually obtained some very favorable fuel hedges that threw their balance or their income statement way off. We'll talk about why that's the case here in just a bit. Probably in the next lecture, we're going to talk about the nature of that. And he said that the reverse held true, that shortly after the financial crisis, the subprime financial crisis, a lot of companies entered into commitments to buy at a particular secured price because they thought the supply was going to drop down. Turns out it didn't, and everybody took a massive loss on their commitments because they purchased it much higher than what the market was selling at. So that goal of commitments is basically to say, I'm a little bit trepidatious about movements in price or movements in availability. I want to secure it now and make sure I've got that locked in. That's the goal here. So accounting standards require commitments to be disclosed in the financial statements with adjustments to OCI for any gains and losses. Now, other than that OCI thing, that sure sounds like a contingent liability because it has to be mentioned in the financial statements. Now, the accounting treatment's different, but our obligation as auditors is the same exact thing. We have to make sure that these are properly disclosed and treated in the financial statements. So how do you think we're going to approach this from an accounting perspective or for an auditing perspective? The answer is we're going to replicate exactly what we did for contingent liabilities, but do it for commitments. We're going to talk to the inquiry and revenue purchasing personnel. We're going to talk to the revenue purchasing personnel, and then we're going to review the minutes of the board of directors meetings. So our audit procedures are basically the same as those for contingent liabilities. So it's twofer. I taught you how to do audit for contingent liabilities. You can take those same things and apply them to commitments. It's like you're learning twice as much information at half the capacity. It's just great. Our main concern relating to commitments is assuring that appropriate disclosures are provided in the financial statements. So our accounting treatment is less critical because OCI is fairly transparent, but the disclosure aspect is critical, particularly because these may relate to the comparability of financial statements over long periods. Now, again, I promise that we'll talk about that when we come back from break, because we'll talk about comparability and how something like a commitment can affect comparability and what it has to relate to with audit responsibility. But for right now, you need to understand that commitments, they have to be fully disclosed in the financial statements by the preparers of the financial statements. All right. Talking about 303, I said we're going to be talking a lot about 303. Let's talk about subsequent events. You guys remember subsequent events for 303? So Dr. Barnes, I got to be honest, I blanked out everything from 303. Well, that's too bad, okay? That's too bad because we really need to talk about things like this, okay? So a subsequent event. Now, the vernacular is pretty transparent, but it does have a very specific meaning from an accounting context. It's an event that occurs after the balance sheet date, but before the issuance of the financial statements, and materially affects the financial statements. Okay. So something that occurs, it's not part of the year under audit, but it's so significant that it failing to mention it in the financial statements would be an omission of magnitude. Okay. So this is something that we as auditors are going to look at and say, look, this does not relate to the period under audit, but we really think you should include it. There was a big example of this about, 5 years and I guess about 5.5 years ago. 5.5 years ago, March 2020, there was a big subsequent event that occurred. I think you all probably in middle school or high school at the time. Do you remember that? And so, no, don't remember that. Yeah. So, okay. Block that out too. That's a lot harder to block out than 303, unfortunately. So yeah, big subsequent event for the COVID pandemic. All right, changed a lot of the approach. Now, a lot of organizations had to include this as a subsequent event because they were issuing their financial statements. They're like, oh, this is going to materially affect our operations in the coming year. People should probably know how it's going to affect it. All right. So subsequent events generally require revenue recognition, just generally require recognition or disclosure in the financial statements. Management is required to disclose the date through which entity is considered subsequent events. Usually that's going to be the financial statement date, but can be earlier. Auditors are responsible for evaluating the entity's handling of subsequent events in the financial statements. Now, in order to do this, we've got to have to go back to a few of our concepts that we learned back from 303. So dredging up old memories. Subsequent events fall into one of two categories. There's type 1 and type 2, which it seems to me that we use type 1 and type 2 a lot in this course for various different things. With this one, we're talking about type 1 and type 2 subsequent events. So a type 1 subsequent event means conditions existed before the balance sheet date and affect estimates that are part of financial statements. Okay. So an example of this would be a lawsuit, like a contingent liability that we had existed, that gets resolved after the balance sheet date. So a lawsuit existed that has been properly recorded as a contingent liability. Then say like on February 12th, I don't know why I chose that date, it just seemed appropriate. I think that's Lincoln's birthday. But February 12th, this gets reconciled, okay? The whole thing gets resolved, and we know exactly what the financial statement impact of the lawsuit is going to be. In that particular situation, it doesn't make sense to continue holding it on the financial statements as a contingent liability. It is now an actual recognizable liability. We know what the impact is going to be. So we're going to adjust the financial statements. Because the conditions existed before the financial statement date, we can make an adjustment to the financial statements because they have not been issued yet. That is what we are going to insist upon as auditors. Now, the other type is a type 2 event. Conditions did not exist at the balance sheet date, and they do not affect the accuracy of the financial statements. Prime example of this one would be a natural disaster, okay? A natural disaster. So you're busy doing your audit work on the financial statements, and the client comes into you and says, we just had a hurricane come and hit one of our facilities in Florida and completely destroyed it. What do we need to do? Your answer would be that is a subsequent event that needs to go into the financial statements and say, well, okay, so what do we have to do with that? The answer is that immediately we're going to say it requires full disclosure in the financial statements, a detailed disclosure in the financial statements, and possibly something called pro forma financial statements. Has anybody heard that term pro forma financial statements before? Basically, these are forward-looking financial statements based on certain assumptions. This assumption is really easy. What would the impact of this natural disaster be on the financial statements for the future? So we can say, here's what we thought was going to happen. Here's what we think is going to happen now that this issue has impacted our financials. So kind of show a before and after comparison to actually have comparability. So everybody really good on this? Everybody feel they've got a strong understanding of subsequent events and can identify type 1 and type 2 events at a glance? I don't believe you. So that's why I invented this game. It's called type 1 or type 2, all right? So I'm going to give you a subsequent event. You're going to tell me is it a type 1 event or a type 2 event, okay? There will be much cheering for successful guesses and many boos for bad guesses, okay? Actually, I won't do either, okay? I'm just going to say good job or not good job. Loss from the entity's manufacturing facility or assets resulting from a casualty such as a fire or flood that occurred after the balance sheet date but prior to the issuance of the financial statements. So by the way, in all of these situations, it's going to be a subsequent event of some type. There's also a possibility that it could not be a subsequent event. That actually comes up in the homework that you'll be doing in a couple of weeks, or next week, I guess I should say. So something to consider is whether or not this is actually a subsequent event. But for these examples, these are all subsequent events. Which one is this, type 1 or type 2? This is type 2. Yes, everybody got that one immediately. All right, type 2. Capital stock or bond issuance by the entity after the balance sheet date, but prior to the issuance of the financial statements. It's a little bit more challenging. What do you think? One or two? So do the conditions exist at the balance sheet date? They did not. So this is a type 2 event, Okay. All right. Settlement of a lawsuit after the balance sheet date, but prior to the issuance of financial statements for an amount different from the amount recorded in the year-end financial statements is a contingent liability. What do you think? Type 1 or type 2? It is type 1. You may be saying, but the amount was different, Dr. Barnes. Doesn't matter. If the conditions existed, it doesn't have to be the same amount. The conditions did exist at the financial statement date. All right. What about losses on receivables caused by conditions such as a business failure arising subsequent to the balance sheet date? What do you think? So conditions is a business failure arising subsequent to the balance sheet date. That's the key vernacular there. Did the conditions exist at the balance sheet date? They did not. So it is a type 2. Type 2. All right. An uncollectible account receivable resulting from the deterioration of the customer's financial condition prior to year end, about which the holder receivable is unaware. Customer declares bankruptcy after the balance sheet date, but prior to the issuance of the financial statements. This is a tricky one, okay? So did conditions exist at the balance sheet date? Yes, we were not aware of them, but they definitely did exist. It says the customer's financial condition existed prior to year end. Okay, so they did exist. So by definition, this is a type 1 event. Okay, type 1 event, which we can go back and make the client adjust the financials for. Purchase or disposal of a business by the entity after the balance sheet date, but prior to the issuance of the financial statements. So after the balance sheet date, prior to the financial statements, we got one of two. What do we got? One or two? Twos, type 2 event. Very good. Very high for success. I don't get to jeer. I don't get to jeer. I can only cheer. Well done. Well done, everyone. All right. So that's going to be the identification of subsequent events, but we do have a couple of other issues that we need to discuss. So there's a window of identification for subsequent events that we need to consider. Now, the good news is for most publicly traded company audits, we don't have to worry about this. Okay. The reason why is that in the recent decade or past decade or so, most companies of public company audits have dated their audit report the exact same date as the financial statements. Okay. However, that's not the case for all audits. Okay. We could have an audit report date that occurs before the issuance of the financial statements. But if you look at this diagram, it says the responsibility period that we have for subsequent events exists beyond the audit report date. It exists all the way to the issuance of the financial statements. So there's two possibilities in this scenario. Okay. One is that we have a subsequent event that occurs right here between this window here. So before the audit report date, before the financial statement date, either one. Okay. That's an easy one to address. We know the auditor has a clear responsibility for that, so we're going to make sure that the appropriate treatment is used. So type 1, make a revision of the financial statements. Type 2, disclosure, possibly pro forma financial statements. What happens if we have a subsequent event occur here, where we as the auditors have already issued our audit report? Okay, so the audit report's been issued. The client's still wrapping up their financial statement issuance, but our audit is done. Shouldn't we be done as well? Shouldn't we say, hey, no responsibility here? Okay, we're on Hawaii, drinking martinis or pina coladas or whatever you do in Hawaii. Okay. I don't know why I thought martinis. Who drinks a martini on the beach? Come on. To each their own, I guess. Yeah. So we're away. Do we still have responsibility for subsequent events during this window right here? Yes, we do. Okay. Yes, we do. If a subsequent event arises, we do have to address that. This is what gives rise to something called a dual dating issue. Now, what does dual dating mean? My answer to this is that back in the late 90s, early 2000s, there were a whole bunch of these reality shows that had like dating game type vibe to it. Like Blind Date was a big one. I thought dual dating would be a really good name for one of those shows, but that's not what dual dating is. Okay. Much to my chagrin. So when a subsequent event after the audit has been completed, the auditor considers the following options for dating the auditor's report. Okay. So we are talking about specifically this window right here. A subsequent event occurs during this window. Our audit report date is specifically saying February 15th, but we've got responsibility for that subsequent event. So we've got two options. The first one is we can dual date the report. This is basically saying there are two different dates listed on the report. One is the audit report date, and the other is that of individual subsequent event data, which we finished evaluation of the subsequent event. Okay, so the subsequent event will say occurred on February 25th. Okay, and we finished our evaluation on February 28th. So we have February 15th and February 28th listed there on the audit report. That would be an example of a dual date. Now, what is the purpose of this? It specifically limits liability of the auditors for the one event referenced, that one subsequent event. We only have to concern ourselves with that single event that occurred after the audit report date. The other possibility is going to be changing the entire audit report date to the date of the subsequent event, or I should probably more correctly say the date the subsequent event has concluded evaluation, okay? Because if a subsequent event occurs, we have to make sure there's proper treatment in the financial statements and the client has done their appropriate due diligence. So remember, subsequent event occurs on the 25th, there's evaluation, and then we conclude the evaluation on the 28th. That would be the appropriate date, not necessarily the date of the subsequent event. That's a little bit of a misnomer. So if we change our audit report dates, we're taking responsibility not just for the single subsequent event, but for all events that occur after the original audit report date. So remember, our original audit report date was February 15th. Our new audit report date is February 28th. We're taking responsibility for everything that occurred in that 13-day window, not just the subsequent event. It is extending our liability for all events. So if you want to limit your liability, you dual date. If you want to extend your liability, if you're like, I don't care, that nothing's bad's going to happen, I'm fine with that, we can just change the audit report date. Those are our two options. So what are some things that we're going to do to identify subsequent events? Well, we're definitely going to talk to management. Okay, we're definitely going to talk to management. Also, we can read interim financial statements. Usually it's too soon to have quarterly financial statements issued, but if the client issues something like monthly trial balances, this could be something, a good opportunity for us to identify for subsequent events. Also, we want to read the meetings and minutes, such as the board of directors and the audit committee, to get any insight or discussion that they might have. We're going to talk to the lawyers. Again, the lawyers are probably not going to give us a lot of information, but they can corroborate things that we already know. And we want to examine the books of original entry. When we talk about that, that's going to be like the journals, the cash journal, the purchases journal, and the sales journal for any odd events that we are not aware of or that seem unusual. Also, when we talk about auditors or review of subsequent events, auditors of public companies are also responsible to report on any changes in internal control that might adversely affect financial reporting at the end of the reporting period and the date of the auditor's report. This is a reflection directly about what we talked about in Chapter 7. So remember back in Chapter 7, we said, if we test a control at one point in time, we have to make sure that control is still operating that way all the way to the balance or to the issuance of the financial statements. So we know that we're going to do test work as of year end to make sure that the control is operating. But let's say we have a control that was operating fully functionally, no weaknesses whatsoever, no deficiencies whatsoever, as of December 31st. And then something happens and we believe that control is no longer effective as of February 1st. Is that considered a subsequent event by this definition? The answer is yes, okay? This would be where we as auditors step in and say, we need to reevaluate controls or this control because we think there's been a change in the nature of controls. So this might happen when there's a key business personnel turnover, somebody who's responsible for the control area, who's responsible for that, and that's been replaced or it's not been filled. So example would be a key segregation of duties where one of the people holding that responsibility is let go or is terminated for some reason. Then we would want to say, all right, is the control still functioning properly? Did they find somebody appropriate in that area? How do we actually identify subsequent events of that nature? Well, we're going to rely on our good friends at Spire Energy, the internal auditors, okay, to identify those. We're also going to look at any regulatory or agency reports in ICOFR. This could be the PCAOB. This could also be the SEC if they do any inspections or identifications. This could also be any regulatory agency that are industry specific that can identify those. We're going to look at the independent auditors' reports of reportable conditions. So we're going to be talking about other work that the independent auditors can do. We'll talk in nature about that in Chapter 21 of what that means. And any information that's obtained from our own audit of internal controls over financial reporting, which is ICOFR. Those are going to identify the key controls that we need to be aware of in this area and the ones that are susceptible to change. Whew, it's a lot to go on, isn't it? All right. Well, the good news, we're almost done. Or we're almost done. We got our final steps in evidence evaluation. So first, before we can issue the report, we need to issue to perform our final analytical procedures. Now, remember, we talked about 3 types of analytical procedures: preliminary, substantive, and final. This is the last one. And the purpose of this one is to make sure everything just makes general sense. We're going to do some analytical procedures, some trend analysis, some ratio analysis, and make sure everything seems consistent with what our expectations are. All right, then we're going to obtain a management representation letter. Now, this is a really goofy document that you need to be aware of, all right? At face value, the management representation letter is a letter that's addressed from management to the auditor, and it details everything that management provided to the auditor over the course of the audit. Now, why do I call it goofy? Okay, that sounds pretty straightforward, right? Based on my description, who would you think would author that letter? Management. Who do you think actually authors the letter? The auditor. The auditor writes the letter as if they're writing it from the perspective of management. Management signs it to make their representation. Okay. It makes a little bit of sense if you think about it. Management is probably not tracking all the information that's being provided to the auditor, but the auditor definitely is, which is why the auditor has responsibility for that letter. But it is addressed from management to the auditor. We're going to review our working papers. Okay. What are we looking for? This is going to be done usually by the audit engagement partner, the person who's in charge of the entire audit. And they're looking for a couple of things: the sufficiency of audit evidence, and they're also looking for any effects of detected misstatements, which we're going to talk about in another slide here in just a second. We also want to perform a final evaluation of audit results. All right. We want to make sure that we understand that what the details are and make sure we have a summary of that, which we'll look at that here in just a second. We'll evaluate the financial statement presentation and disclosure. Mostly, we're going to make sure that's compliance with the specified reporting framework, which for PCAOB audits is always going to be generally accepted accounting principles, GAAP. We also want to make sure we obtain an independent review of the engagement. Now, what is this? How is this different from this review up here? Why are we obtaining an independent review? We want it to be reviewed by somebody who's associated with the engagement and somebody who is not associated with the engagement. In a large firm, this is usually going to be a non-engagement partner, somebody who is not on the engagement that has a fresh perspective. In a small firm, this could actually be another audit firm. And it makes sense if you think about somebody who's a sole proprietorship, if they're doing an audit, a financial statement audit, and they need an independent review, well, there's only one partner in the firm. That partner can't also perform the independent review. So we can have other auditors do the work as well. We also are going to evaluate the entity's ability to continue as a going concern, which is a big deal, but we're going to talk about that shortly, okay? So we do have some things to talk about. We're going to talk about a few things with respect to what are on this document right here. So let's go ahead and talk about the two primary issues of evaluation of audit results. So the sufficiency and appropriateness of audit evidence. We've talked about that back when we were talking about documentation in Chapter 5. What is sufficiency and what is appropriateness? Quantity and quality. We want to make sure we have enough audit evidence and that it actually represents what we're trying to test within our documentation. What it says test and what we're actually looking for. We also want to make sure that we understand the effects of detected but uncorrected misstatements in the financial statements. So we're going to have a list of those, and we're going to take a look at that here in just a second. A list of the detected but uncorrected financial misstatements in the financial statements. We're going to prepare a document that we're going to present to the client and say, here's what we found over the course of the audit. Additionally, the auditor should evaluate financial statement presentation with disclosure to ensure compliance with GAAP, proper representation of accounts, and inclusion of all necessary disclosures. So basically, we're just trying to make sure that we evaluate what's going on in the financial statements and everything is presented correctly, and that the final issuance of the financial statements is what we would expect it to be. Now, I said we're going to look at an example of detected misstatements. This is an example of a working paper. This is for earthware. I think it's a little bit dated, but this is kind of an example of that. So you'll notice that we've got a lot of items here. These are items that are that we summarize as detected misstatements. And then we as auditors say, because this account is misstated, we propose the following adjusting entries. So we've got some journal entries in here. What we would recording here. So this is saying, so we've got an accrued liabilities that's understated by 215,000. We believe that we should record a liability for 215,000 and offsetting debits to payroll expense and bonuses for those amounts. That would be an example of the journal entries we present to the client. Now, real quick, does the client have to accept our journal entries? Are they required to book these journal entries? They are not. These are just suggestions on the part of the auditor, and these suggestions will be retained regardless of what the client does. We will subsequently evaluate whether the client has made appropriate adjustments to the financial statements to present them for being materially misstated. So you'll notice here as we look at all this that we could say the liabilities are misstated by 442,000 and expenses are misstated by about 527,000. So roughly $1 million. Let's say my threshold for materiality for my planning materiality was 800,000. Minimally, our client would be required to make an adjustment of at least around $200,000 to come within scope. Now, if they fail to make any journal entries, we would say the financial statements are materially misstated, and we had to explain why. This is our threshold for evaluating those statements. So remember all the way back when we talked about it, this materiality, say, what are the actual misstatements? This is our list of those items right here. And these are the ones that have to be adjusted for. All right. Going concern. What is a going concern? Is that a good thing or a bad thing? If I say I'm a going concern, is that a good thing? We hope so. We hope so. Okay. I would like to be a going concern at Truman for about another decade. Okay. So a going concern just basically means it's going to continue for the foreseeable future. All right. ASU 2014-15, disclosure of uncertainties about an entity's ability to continue as a going concern, requires that management assess the entity's ability to continue as a going concern. So this is relatively new. I know 2014 seemed like a long time ago. It's like half your lifetime. But for me, I was still in the PhD program. So it wasn't that big deal. It was not a long time ago. So basically what this says is management has to annually evaluate, are they going to be in business for the forthcoming year? All right. Now, under PCAOB Auditing Standard 2415, the external auditor must also evaluate whether there this going concern issue. Specifically, is there substantial doubt about a client's ability to continue as a going concern for a reasonable period of time? And again, the reasonable period of time criteria is usually going to be a year. Can it be adjusted? Yes, but for the most part, that's going to be our default. So we are going to look at management, and we're going to say, we'll look at management's work and say, we believe the business is under threat, and we believe that you may not be in business a year from now, absent some possible steps that you need to take. What is it that we need to do as auditors? Well, there's a 3-step process that we need to discuss. Okay. So the first thing is we're going to ask, do the audit procedures, the work that we're doing, indicate that there is doubt about, or indicate there's substantial doubt. Okay. So we're doing the audit. We say, oh my gosh, look at these financial ratios. Like cost of goods sold as a percentage of sales has increased like 30% over the past 2 years. How are they going to stay in business? It's a good question, right? Okay. Cost of goods sold increasing by 30%. That seems outrageous until you consider that that's happened for a lot of businesses recently. All right. So what is going to be an example of that? So substantial doubt. Then we're going to go talk to management. We're going to say, all right, your margins are diminishing massively. What are you doing in response to that? And they say, well, we're going to explore new supply channel chains. We're actually going to increase the prices of our products, and we're going to do what we can to actually maintain, cut costs in other areas. And if you look at that as auditors and you say, hey, that sounds good. I think that this is going to be a successful approach. This is going to be a successful plan. We can just walk away and do nothing else. Okay. But what happens if you say, what are you going to do to address this problem? And they say, oh, we didn't even know there was a problem. That sucks, dude. Yeah. Then you're going to be like, okay, my substantial doubt is still there. Okay. I still have substantial doubt. That is when we are going to evaluate the adequacy of their disclosure. Did they put information in their own financial statements about this substantial doubt or about this going concern issue? Because they are required to do so according to 2014-15, ASU 24-15. So client has to disclose this, and then we as auditors are also going to disclose this in our own report. We're going to add what's called an explanatory paragraph to our audit report saying, hey, just a heads up, this company may not be a business a year from now. Thought you might want to know. Now, I want you to make a note of this. You'll hear me harp on this again when we get to chapter 18, but this is a really important concept, okay? The existence of a going concern issue, the existence of substantial doubt, is not sufficient to result in a change in the opinion, okay? You could have really, really immaculately presented financial statements. They're beautiful, but the company is going to go out of business in the short term. That does not change the opinion that we're going to issue as auditors. Okay. So existence of substantial doubt does not change our opinion. That's a big issue because that's always confusing for students who are taking this course. So substantial doubt exists, that does not result in a change in opinion. Now, I want to clarify that. I want to contrast that to if we do know that substantial doubt exists and the client fails to disclose this in their financial statements, that would result in a change in opinion. Okay. Now, what's the difference? Substantial doubt exists, but the client has addressed it properly in the financial statements. We're going to say, all right, doesn't change the going concern issue, but we're going to issue a clean opinion. If we go to the client and say, hey, there's substantial doubt, they say, we know, but we're not going to put it in the financial statements. That's where we would jump in and say, all right, qualified opinion or adverse opinion. You're not following GAAP rules. There's a difference between those two concepts. So when you're thinking about going concern, you have to evaluate both of those concepts. So we're going to evaluate whether management has effectively disclosed this in the financial statements. If the answer is yes, we don't have to change our opinion. We just have to add this paragraph. If the answer is no, we still have to add the paragraph, but we also do need to change our opinion. It's an important distinction. All right. So archiving and retention. So once the audit is completed for public companies, PCAOB Auditing Standard 1215 and SOX require public companies to retain their audit files for 45 days when the completion of audit. Since most audits for public companies are electronic nowadays, this is actually a pretty simple process. You just aggregate all the documentation associated with the audit and you file it, and then make sure you do that in a 45-day period. 7 years is the period of time in which it's held. For most of those audit files, they're going to be deleted after 7 years because some of that information may be proprietary and sensitive in nature. There is a caveat to that, unless a longer period of time is going to be required by law. That does happen occasionally, especially if we're talking about high litigation risk areas. Okay. We also need to make sure that we retain all documents that form the basis for the review. Additionally, we include any information that's inconsistent with the issued opinion, which sounds controversial, doesn't it? So you're auditing, you issue a clean opinion, but there was one area of the audit where you thought that there might be a material misstatement. You have to include that and justification for why it did not change your opinion. So you're looking at inventory. Inventory appears to be materially misstated, but you say, well, that was because their basis of opinion was not consistent with what we had eventually adjusted to, and we believe that the adjustments are appropriate to make sure that this is not a material misstatement. Some sort of justification like that, even if it's inconsistent with our audit opinion. All right. We don't have much time, but we still have a couple of lists that we need to go through. So let's go ahead and make sure we note. Auditing standards require the audit committee communicate the following matters to the board of directors audit committee. So this is stuff that we're going to make sure that's communicated both to the board and to the audit committee. Auditor's responsibility and the terms of the engagement, information provided by the audit committee that's relevant to the audits, overview of audit tribe strategy, timely observations that are significant to the financial reporting process, all significant deficiencies and material weaknesses identified to the audit, which we know that from chapter 7. We know that all significant deficiencies and material weaknesses get reported to the audit committee. And then we got this thing called a management letter, which is not the same as management representation letter. This is a letter that's from the auditor to management that has any suggestions or recommendations for the client. So there's a little bit of a distinction. Remember, a management representation letter was from management to the auditor about what it is the management provided, even though it's drafted by the auditor. This is actually to management from the auditor that says, here's what we recommend that you do for the future. Usually this is going to be focused on controls and operations improvements. Now, last thing we're talking about, you're sitting on your beach drinking your margarita or your pina colada or your martini, whatever it is, okay? And the client contacts you and say, hey, there's some information you should know. You know that inventory that you gave us a clean opinion about? We forgot to tell you about an existence of a warehouse of inventory. That's going to be something that's relevant to the financial statements. That's called subsequent discovery. And if this occurs after the audit, we still have a responsibility for this information as the auditor. So we're going to get out of the beach, we're going to board a plane, and we're going to go audit that warehouse, okay? Make sure that it doesn't change the opinion that we rendered. That's optimally what we're going to do. We do have responsibility for any additional information that's relevant. What if we try to do that and the client says, well, you know, we'd rather not you do that because that's going to change your opinion and we're really happy with our opinion right now. So no, you can't audit this new information. At that point, we as auditors are going to step up and we're going to say, well, you can't use our audit reports. And okay. What happens then also, they can't use the audit reports. We're going to contact any regulatory agencies that are using that report and tell them about the situation. For public companies, it's usually going to be PCAOB or the SEC. We're just going to say, yeah, there's been a change. Our audit report is no longer reliable, so you should no longer use it. We also have responsibility to notify each person, the auditor relying on the financial statements, known to be the auditor relying on financial statements. If it's a large company, it's usually going to be the regulatory agency who will handle that for us. If it's a smaller company, then we need to contact the direct stakeholders for which the audit report was created for. So like the bank or creditors or whoever that might be. And that does it. We are done with the conclusion of the audit. Have a wonderful break. I'll see you all on Monday.